Welcome to today's earnings deep dive into Johnson & Johnson's Q4 2025 performance. In this analysis, we'll dissect the key drivers behind their results, management's forward-looking guidance, and the overall investment thesis. This analysis is strictly for educational purposes and should not be considered investment advice. Let's begin with the key takeaways. Johnson & Johnson reported Q4 revenue that met analyst expectations, showcasing stable growth in a challenging market. Profitability metrics demonstrated solid operational efficiency, maintaining strong margins. Management provided guidance indicating continued steady growth for fiscal year 2026, reflecting confidence in their diversified portfolio. This earnings analysis will provide a balanced view of J&J's performance, opportunities, and potential risks. Remember, this is educational content only. Looking ahead, Johnson & Johnson's management has provided guidance for the next several key factors. Revenue growth was primarily fueled by strong performance in the pharmaceutical segment, which saw a notable increase in sales attributed to new drug launches and increased market penetration of existing products. The medtech segment also contributed positively, driven by innovative medical devices and surgical solutions. Consumer health remained relatively stable, with strategic pricing adjustments and product mix optimization supporting revenue. Operationally, Johnson & Johnson demonstrated efficiency through cost management initiatives, resulting in margin expansion. Specific segments such as oncology and immunology within pharmaceuticals showed substantial growth, contributing significantly to overall revenue. Furthermore, successful product launches in key markets bolstered the company's competitive positioning. The company's commitment to innovation, particularly in areas like gene therapy and precision medicine, also served as a catalyst for growth. Looking ahead, Johnson & Johnson's management has provided guidance for the next quarter and full fiscal year 2026. The company projects continued revenue growth, anticipating a YoY increase in the low single digits. This projection reflects confidence in their diversified portfolio and pipeline of new products. Management also anticipates margin expansion, driven by operational efficiencies and strategic cost management initiatives. They highlighted strategic initiatives, including investments in research and development and expansion into emerging markets, as key drivers of future growth. Analyst consensus aligns with management's guidance, with expectations of continued steady growth. However, some analysts express caution regarding potential headwinds, such as pricing pressures and regulatory uncertainties. The company's commentary suggests a balanced approach, acknowledging both opportunities and challenges in the current market environment. Overall, the guidance indicates a stable outlook for Johnson & Johnson, with expectations of continued growth and profitability. Wall Street analysts have provided revisions to their estimates following Johnson & Johnson's Q4 2025 earnings report. EPS growth rate projections have remained relatively stable, reflecting confidence in the company's ability to maintain profitability. Revenue projections have also seen minor adjustments, aligning with management's guidance. Current valuation metrics, such as PE and EV/EBITDA, are in line with historical averages, suggesting that the stock is fairly valued at current levels. Price target ranges from brokerages vary, reflecting different perspectives on the company's growth prospects and potential risks. Some analysts view the stock as undervalued, citing its strong balance sheet and diversified portfolio. Others express caution, highlighting potential headwinds and regulatory uncertainties. Overall, the analyst view is balanced, with a consensus rating of hold to buy. The stock's valuation appears reasonable, considering its growth prospects and risk profile. In conclusion, Johnson & Johnson presents a balanced investment thesis. The bull case is supported by its diversified portfolio, strong balance sheet, and commitment to innovation. Growth drivers include new drug launches, expansion into emerging markets, and strategic cost management initiatives. However, the bear case highlights potential risks, such as pricing pressures, regulatory uncertainties, and competition from generic drugs. Key risks to consider include product liability litigation and potential disruptions in the global supply chain. This analysis is for educational purposes only. This is not investment advice. Always do your own research and consult with a licensed financial advisor before making any investment decisions. Key metrics to watch going forward include revenue growth in the pharmaceutical segment, margin expansion, and progress on new drug development. Furthermore, monitor analyst sentiment and any changes to management's guidance.